Hello traders, and welcome back to Explain the Charts. Today is October 24th, 2025, and we're taking a deep dive into EURUSD, a pair that's at a fascinating crossroads of conflicting economic signals and geopolitical tension. First, let's cover the news driving the market. The dominant theme is a strong US dollar, with the DXY index trading near 99.00, fueled by safe haven demand. This demand stems from renewed US-China trade friction and a lengthy US government shutdown, now in its 23rd day. However, there's a major paradox at play because the Federal Reserve is signaling a distinctly dovish stance. Fed Chair Jerome Powell has pointed to a cooling labor market, and the market is pricing in a 97% probability of a 25 basis point rate cut at the October 29th meeting. This expectation of monetary easing is typically a headwind for a currency. Meanwhile, in Europe, the ECB remains in no-rush mode, maintaining a patient, data-dependent approach with no significant policy shifts expected soon. This monetary policy divergence, with the Fed actively easing while the ECB holds steady, makes the euro less attractive from a yield perspective, adding to its underlying weakness. The next huge catalyst on everyone's radar is the upcoming US CPI inflation report. A hotter-than-expected number could delay future Fed cuts and send the dollar even higher, while a soft print could do the exact opposite. Some analysts are even floating long-term forecasts of EURUSD returning to parity, or 1.0000, a level not seen in years. So, with that complex fundamental backdrop, let's turn to the charts to see what the price action is telling us. Here we have the daily chart for EURUSD, showing the price action over the last year and a half. What's immediately striking is the major trend reversal. After bottoming out near 1.01 in January of this year, EURUSD entered a powerful uptrend that lasted for 9 months. That bullish run culminated at a peak of 1.1918 on September 17th. This 1.19 level now stands as a massive psychological and technical resistance area. Since that peak, the trend has decisively shifted bearish. We can see a sharp, sustained sell-off through the end of September and into October. The price found a temporary bottom, or a key support level, around 1.1542 on October 9th. This level is critical because it represents the first major floor established during this new downtrend. Following that low, the market attempted a recovery, rallying back up. However, that rally stalled on October 17th at a high of 1.1728. This is a classic technical sign of a downtrend, a failure to make a new high, instead printing a distinct lower high well below the September peak. This failure at 1.1728 confirmed that sellers were still in control and has since initiated the next leg down, which is the price action we are currently in. Let's zoom in on this recent action by filtering our daily chart to just the last month. Here you can clearly see the peak on October 17th near 1.1728 and the 5 consecutive days of selling that followed. The price has been in a clear descending channel since that high. The last few candles show a struggle, with price dipping below 1.16, but finding some buyers. Yesterday's candle, for October 23rd, is particularly interesting. It had a low of 1.1584, but managed to close much higher at 1.1617, forming a small bullish hammer-like candle. This suggests some buying pressure is emerging near this 1.1580 support zone, but it's far from a confirmed reversal. To get a better feel for this battle between buyers and sellers, let's drill down to a shorter time frame. Switching to the 15-minute chart, we can see the intraday movements of the last few days in detail. Notice the series of lower highs and lower lows from October 21st, which is characteristic of a strong short-term downtrend. The price broke decisively below the 1.1640 level and accelerated downwards. We can pinpoint the low on October 22nd near 1.1575. Then, yesterday, we see the price action that formed that daily hammer candle. Price made another attempt at the lows, hitting 1.1584, but was met with buying pressure that pushed it back above 1.16. However, since that bounce, the price has been consolidating in a tight range, struggling to gain any significant upward momentum. It appears to be capped by resistance around the 1.1620 area on this time frame. This choppy, sideways price action shows indecision in the market as traders await the next major catalyst, likely the CPI data. So, let's bring it all together and recap the key levels and potential scenarios. The dominant, long-term trend is bearish since the reversal from the 1.1918 high in September. Our immediate overhead resistance is now around the 1.1650 mark, followed by the more significant peak at 1.1728. To the downside, the crucial support zone to watch is between the recent lows around 1.1580 and the October floor at 1.1542. A decisive break below 1.1542 would open the door for a much deeper correction. Now for our potential scenarios. The bearish scenario, which aligns with the current trend, has a higher probability, let's say around 70%. This would involve the price failing to overcome resistance at 1.1650 and eventually breaking down through the 1.1542 support. A hotter-than-expected US CPI number would strongly reinforce this outlook, likely sending the price towards the next major support level at 1.1391, which was the floor back in August. Conversely, a bullish scenario has a lower probability, perhaps 30%, as it would require fighting the dominant trend. For this to happen, we would need to see a strong break and hold above 1.1650. This would likely require a fundamental catalyst, such as a surprisingly weak CPI report that spooks the dollar bulls. If the bulls can achieve this, their first target would be retesting the 1.1728 resistance. Long-term, the technical picture remains bearish. If support at 1.1542 fails, the path towards 1.1200 and even lower levels mentioned in some forecasts, like 1.0600 or 1.0330, becomes increasingly plausible over the coming months. The talk of parity at 1.0000 is an extreme target, but the breakdown from the 2025 uptrend makes it a possibility to keep in the back of your mind. In the immediate future, keep a close eye on that US CPI data, any headlines regarding US-China trade, and, of course, the Fed's decision on October 29th. These events will dictate whether the support at 1.1542 holds or breaks. And that wraps up our analysis of EURUSD. Remember, this is not financial advice and is for educational purposes only. Trading involves risk, and you should always do your own research before making any investment decisions. If you found this breakdown helpful, please hit the like button, subscribe to Explain the Charts, and let us know your thoughts in the comments. Thanks for watching, and we'll see you in the next one.